Many of us don't know that the indexation benefit that we practice in the real estate sector is actually available from India if we were to invest in the US stocks directly. So today, let us do one thing. What happens if from a long-term perspective, we invest from India in the US, say in the New York Stock Exchange, Nasdaq-100, and compare the performance with that of investing in our own IT sector, the NSE IT index, and see how they fare after taxation. There is a single ingredient which comes into play when we invest in the US markets. This ingredient is not available when we invest in the Indian markets directly. We will know more about this ingredient as we go through along the video. Stay tuned. When you invest from India, your final returns aren't just about how the market performs. They are shaped by a chain of hidden costs and taxes. And when you move the money abroad, currency depreciation or appreciation of the rupee against the dollar, there are indexation rules that inflate your cost base. And finally, the capital gains rate, which differ for an investment within India versus a foreign investment. So in this section, we will break down and compute every overhead and tax step by step, and then see what your $1,000 grow into 5 years when you had put it into an India's Nifty IT ETF versus that of a US Nasdaq-100 ETF. For the US Nasdaq-100 ETF, we have taken QQQ, it is called as the 3 cubes, and in the Nifty IT ETF case, we have taken ITBEES. Let's compute for the returns in India for the $1,000 investment that was made 5 years ago. That time it would have equaled 73,700 INR at an exchange rate of 73.7. Over 5 years, ITBEES delivered an absolute return of 113.8%. So the investment grew to 1,57,570 INR before taxes. In India, the first 1 lakh of long-term equity gains are exempt, leaving us with 57,570 which is taxable. It is taxed at 10% and hence the tax is 5757. Post-tax, the ITBEES investment is now worth 1,51,830, which is around $1,709 at today's exchange rate. That means $1,000 has become $1,709 in 5 years, giving us a CAGR of 11.31%. Now let's compute the returns for QQQ. A $1,000 investment has grown to 121.8% in 5 years. Hence $2,218 before taxes. For tax purpose, we need to convert the initial $1,000 at the 2020 exchange rate of 73.7, which is 73,700. We have an indexation of 20.6%, and hence the adjusted cost is now 88,882 INR. For foreign investments, capital gains must also factor in the USD INR currency movement, not just the dollar return. So, after indexation, the capital gain works out to be 1,08,054 INR. We have for foreign investment a 20% long-term capital gain, unlike the 10% for the local long-term capital gains for equity. Hence, the tax payable is now 21,610 INR. We should also note that the tenure for the short-term capital gain for an international investment is 2 years, and greater than 2 years is considered long-term. Unlike the tenure for local Indian investment for equity, etc. is 1 year. So now this leaves a post-tax value of about $1,974 in today's dollar terms. That means $1,000 has become $1,974 over 5 years, giving a CAGR of 14.6%. The hidden driver of returns here is the USD INR conversion. Since India is an export-driven economy for goods and services, but also a major importer of oil and other essentials, the RBI generally manages only the volatility of the rupee, not its long-term value. Over time, market forces have led to the gradual strengthening of the USD against the INR. And this works in favor for Indians investing in US markets. Also note, in ITBEES, the 1 lakh MTCG rebate is capped. So, for larger investments, the taxable portion in India grows quickly. Whereas for QQQ, the benefit of indexation and USD appreciation makes the post-tax CAGR much stronger. Of course, past performance does not guarantee future returns, but by understanding these mechanics, indexation, taxation, currency effects, one can better evaluate the real drivers of long-term wealth creation in the US markets vis-a-vis the Indian markets.
What makes the Tatas, the Ambanis very powerful is that they set up industries, and these industries get carried on from generation to generation like a hire loop. Each generation improvising the one that the earlier generation had provided. Similarly, if we want to pass on an international asset, how do we do it such that it can be passed on from generations and each generation benefits from what you have passed on? In the next section, we will have a way in which we can create such an international asset that can get carried forward from generation to generation, and each generation the asset becomes as much more relevant as it is in the earlier generation. Stay tuned.